So to round it up here, end up chapter 17, and we'll take a look here. Private securities litigation. So we're talking here, again about private or closely held. Okay. So only the SEC can sue third parties that aren't directly responsible for securities violations. Those damages are going to be limited. The private plaintiff must allege Schlenter. I don't know if that's spelled right. I think it's supposed to be Schlenter. But that's just a fraudulent activity. Saying a diamond is a diamond when it's, or saying glass is a diamond, when it's not, or fool's gold is gold, that type of a thing, okay, or some kind of a scheme to defraud, okay, would be Schlenter. And in order for those things to happen, so not a lot of that. Again, some of your guys' white collar things were there. State blue sky laws, if we have some, and Montana has some under MCA Title 30, Chapter 8. I'm not going to ask a lot of questions. Again, there's not a lot of stuff that goes on in Montana in regards to this. Certainly there are some rules and regulations, that have to do with fraudulent transactions and those types of things, but Montana is not a big state when it comes to that. So Sarbanes-Oxley, right? You guys had this in your assignment. Things that, happened, right? Congress increased the SEC authority, increased their budget, gave them these other things, right? Also created the Public Company Accounting Oversight Board. A lot of this was important, separating the auditing and consulting firms. And what's that mean? Well, the consulting firms really, the firm that might do the tax returns, but also consult, if they're preparing financial statements for financing and those types of things. And the auditing company then is different. So now we have to have a whole separate company come in and do an audit of a corporation's books. Okay, and so one, for big corporations, you're talking one big accounting firm, basically comes in and audits the books that another accounting firm prepared. So you kind of a check just to make sure that, there's not fraudulent stuff going on that might involve the accounting firm. That's what happened. Again, you go back to that Enron thing. Increased independence of the auditors. Okay, so they've got more ability to do things. Maintain trust of the public and corporation shareholders is what the SH would be there. At least one member of the audit committee has to be a financial expert, and there's some definitions about that. It can be an accountant, it could be a tax lawyer, it could be even somebody with an MBA basically would be considered a financial expert. And the auditor reports directly to the audit committee, as opposed to like the board of directors. Although they could go around the audit committee if there was some stuff going on there. And audit records have to be maintained. Most controversial, CEO and CFO have to certify the accuracy of quarterly and annual. So they have to sign them. They actually do sign them. And again, the Enron was the cause of this. I mean, Enron caused a lot of these, but there were other companies that, went broke kind of at the same time. But what happened in the Enron case was that when they went to try Kenneth Lay, who was the CEO, he claimed he didn't know. Okay, he claimed that he didn't know that the books were being cooked, and that was his defense. Basically, he said, "No, that was the CFO that was doing that. I didn't know it. So when I went public and said things were going well, I was basing that on what the CFO was presenting me. It was all his fault." Well, he didn't get away with that. He ended up getting convicted, but nonetheless, the SEC looked at that and said, well, you know what, if they sign the quarterly and annual financial statements, they can't use that as a defense. They're signing them and swearing as to the accuracy to the best of their knowledge. So kind of completely eliminated that as a defense. And again, those are the subject to independent auditor review. Any of these financial statements that go into the SEC. And executives must return bonuses paid as a result. And I haven't seen much of this, and I guess you could argue maybe the law has been effective because we really haven't seen executives returning bonuses. So Bernie Ebbers, it's kind of a sad case there. You go back, it had to do with long-distance phone calling, and oh shoot, now I can't even remember the name of the company. It was interesting. He at the same time, kind of as Enron, he was out talking up his stock, but a little bit, and even while the company was going downhill. And so he was convicted, but the sad thing is he didn't sell his stock. He didn't take advantage of it, so he ended up riding it all the way down, and went broke, and also I think got convicted of some fraud. So some other things that it did: securities fraud punishment, conspiring. It gave protection for whistleblowers. In the Enron case, for example, there was somebody that stepped forward, but didn't. I think ended up getting fired and didn't have a lot of protection, so they put those protections in. This probably should be back closer to the start, but it talks about IPOs and the IPO market. It was huge. The total number of IPOs and the gross dollar amount was huge. Back in 2000, and you guys don't remember it. You were barely alive, but that was the .com bubble. Anything that had .com was selling, and they were selling IPOs, and people were bidding them up. And the chairman of the Federal Reserve at the time commented that there was irrational exuberance going on in the marketplace, and turned out that he was right. Okay, and it's kind of been up and down a little bit. 2006, 2007, we had a bit of a spike there, kind of, a little bit, and it dropped off because we had the market crash, right? So it really dropped off then, and then picked back up substantially, a little bit down. I think I looked this year, and they're down again, or for 2016, I think they were down again a bit in 2016. That's kind of a segue, actually, into our next deal, which is consumer protection.